but we don't know about 8.
Yeah, I think in the middle of 2017 or like, February or somewhere around that, they retroactively instated for 2016 and 2017. They just haven't done it yet for 2018 or any other years.
What was the other one that was,
The mortgage insurance premium deduction and the discharge of indebtedness on the home. Function notes about tuition and fees, so if everybody's on top of that, we don't need to go into detail on that. Okay, so the Oregon 529 savings plan for funds used for K-12 tuition. Oregon doesn't follow that. We still do. It's still an Oregon College savings plan, what it's called. For federal, you can use these funds for K-12, presumably for private school, and you would still be qualified, but you can't do that for Oregon. So if you did, you were qualified for Oregon, or excuse me, for federal, you would have to then add back, make an addition for Oregon. The corporate for C corporations this is specifically talking about C corporations and repatriation. So what they did is they made it so you have to make an Oregon addition on your corporate return, and then you can have the dividends received deduction of 70 or 80% depending on what you qualify for. And I don't know if you guys remember. So they had before, I think it was 2014 to 2016, they had the tax haven law, or what was the illicit jurisdiction law. And basically, if you had a controlled foreign corporation in the Maldives or something like that, they said, well, basically, you have to add that back to your Oregon taxable income. So some people had to add that back, and now they have to repatriate, so it's the same income being added twice. And so we've created a credit so that people don't get double taxed. Okay. Okay, the state transit tax, 0.1%. Yeah, this is gonna be interesting. Basically, if it's 0.1%, let's say you make $50,000, you gotta pay $50 in tax. So it's required withholding for all employers that are physically located within Oregon. So a lot of people won't have to deal with, a lot of individuals won't have to deal with this because their employer will withhold on their behalf. And the employer is required to file quarterly reports. It's important to note that those reports are not on the Oregon combined form. Usually the payroll combined form that you would submit for payroll taxes would have all the payroll stuff with it. This is a separate form. Unfortunately, we were not able to get them all in the same form this year. So hypothetically, I shouldn't say hypothetically. This money will go towards basically like transit stuff, like the MAX or whatever, the bus, things like that. If you want more information on that, I think ODOT has the details of exactly what the money is going towards. Go ahead.
Is it a deductible tax on Schedule A?
It's an income tax. So you would have to add it back for Oregon, but it is deductible up to the $10,000 limit on your Schedule A.
Oh, so it's tied in dollars.
Yeah, it is an income tax. So, okay, oh yeah, so this should show up on box 14 of the W-2, and basically most everyone should have this in their box 14, and if somebody has wages, you don't see it in box 14, that's just kind of raise a flag that maybe they need to file this individual tax return. So we'll go into some scenarios about when you would need to file this tax return as an individual as opposed to an employer. I'll go a little bit deeper on the what the employer requirements are. So yeah, the tax was starting being charged on July 1st. So the quarter is July 1st to September 30th. The payments are then due October 31st, and the first quarterly forms are due October 34th. For agricultural filers, there's an annual form as opposed to quarterly. And also Oregon domestic filers, have like a special form that they file on. It's also yearly, and those are the payments and the forms are due on January 31st of 2019. Okay, so you can kind of see the forms here. This is basically check the quarter box, what quarter is are you paying for, your federal identification number, your organ VIN, amended return, yeah, basically demographical information, and that's where you would that's the OR SCT1. The OR SCT2 is where you would actually calculate the tax owed. You would put the employees' their social security numbers, the amount of tax wages that they had, and what's the actual tax. And this is what employers would be filing. If for some reason the employers forget or refuse to, oh, go ahead.
I was just curious that withholding on employee wages and the fact that most departments involved.
For self-employment? No.
Because they already become private.
That's right, makes sense.
Yeah.
This only affects W-2 wages, yeah. Okay. So, additional requirements to the employer. Basically, if for some reason you forget or fail to withhold this and you're an Oregon employer, you can be charged up to $250 penalty per employee per tax period, up to $25,000 per period. So Oregon has no authority to make out-of-state companies withhold any tax. And so this is when we'll start getting into the scenarios where you might have an individual who has to file. So you can have an Oregon resident who is subject to the tax regardless of where they earn their money, but they work, say, for example, in Vancouver. So they have an employer in Vancouver who doesn't want to withhold the tax for whatever reason. It's an administrative burden, they don't feel like it, whatever, I don't know. So this individual would have to pay the tax. They would have to file a form, wait for it. There we go. ORSCI. So that's the individual tax return. So you can file this along with your personal income tax return. They're not the same forms, to be clear. They have the same due date and the same payment due date. So you wouldn't have to file this quarterly like as if you were an employer. You just do the annual return and just the one-time payment. So you'd be due with that. Well, oh, go ahead.
Can they be e-filed or
No, I'd say they can be e-filed. Yes, they can be e-filed. There are a list of compatible software, and I do believe H&R Block is on the list of softwares that is compatible with this tax return.
Yay.
So what I was saying before is like you look in is there another question?
So I just put it, the employer is actually, Oregon, or the headquarters someplace else just happen to have branches here, or
No, so
self-employment, or
if you're physically
partnerships, those are all,
no, it's any type of employer as long as you have an employee. So if you just
independent contractor employees can work herself.
so if you're self-employed, this doesn't apply. If you have a W-2 wage, then this applies to you. This only applies to W-2 wage. Yeah, if you have self-employment income, this does not apply to you.
So who created this form?
Who specifically created this form?
Where?
Did the employer create this form? I don't know. I think the Department of Revenue created this form.
So I have to wait in regards to this form, because it's e-filed, and you have someone coming in that's worked out of state, but they're Oregon residents, so they have to file this to pay their share of the joint taxes.
Yeah.
Will it be part of what we do for the tax return?
It could be,
It
yeah.
should
It could
be.
be. They do have to file it, so yeah, if you want to provide that service, then yes.
So it would be due on April 15th, so, okay, that's
So if we don't see it in box 14
Exactly.
scenario,
Choose that form.
then we need to be asking more questions of that person as to where did you actually work? Because maybe we get W-2s from all over, because the corporation is located back east. But that doesn't mean that they didn't work in Oregon.
Yeah, they have,
We need to know, but if they're an Oregon resident and it's not in Bucksport, Maine, pretty much it's due.
Yeah.
yeah, I mean, there would be, like I was saying before, there's a rare scenario where you're physically located in Oregon, you're an employer who's physically located in Oregon, for whatever reason you refuse to withhold the tax, the individual is no longer liable for that tax. The corporation would be, or the, you know, the employer, I should say. That'd be kind of like a rare scenario, and we'd just have to deal with it on a case-by-case basis. So you would, you know, maybe file the tax, but then it would turn out you weren't liable for the tax, you would get your money refunded or something like that, but there's no way we'd have to knowing that, but.
What's going to prompt us to know that we have to do it, to file it then?
So,
If they're an Oregon resident.
yeah, if they're an Oregon resident and they have no withholding in box 14 on the W-2.
Do you know what the code is going to be, so that we can?
Oh, in box 14, yeah.
In box 14?
So there's no specific code, but they basically said it should be like STT or STI, one of the two. But yeah, you should be looking for something like STT, STI, something like that, and that should tell you it's a state transit tax. I don't think there's like a specific rule saying you have to label it this thing. We're just hoping people will be all on the same page. Go ahead.
Can you clarify if this applies to a Oregon resident who has wages outside the state?
Yes, it does.
Yeah, that's, yeah.
Here that it says refund for non-residents working in Oregon. I live in Washington. I work over here. Does that mean I get a refund on it?
You have to
It depends on the
file.
scenario. I was going to go into that. I'll go into that in a second. I'm going to answer a few more questions, and then I'll go over that scenario.
If it's not labeled SCP or STI and it's in box 14 and it's 1/10 of 1% of the amount in box.
There we go. You should be good to go.
Yeah, because a lot of people put TriMet taxes in box 14, and they also put the workers' comp in that spot as well. So that's gonna, there's gonna be a whole lot, there could be 3 lines in there now, depending on what the
Yeah.
employer does.
Yeah, it will be important to distinguish from TriMet and making sure you're not confusing it with TriMet tax.
But if they made less than 50,000, then they wouldn't have the transit tax.
No, that was just an example. There is no de minimis amount. If you earn any amount, then you have to be subject to the tax.
Presumably, your residents only have to pay for the period that they have to live.
So the wages that they earned in Oregon would be subject to the tax. The wages, yeah, if they were part year and they were no longer a resident of Oregon, then they're not subject to the tax. Unless they earned them in Oregon.
So if you have an individual who works and earned like $150 in a year, like one job, one day, whatever, they're not required to file their taxes,
Yeah.
but are they required to pay this because there's no de minimis?
I mean, I think technically, yeah, because it says there is no de minimis, but whatever, right? What are they gonna do? I don't know what the collection threshold is. I would imagine, yeah, 15 cents is below the.
What about penalties?
Penalties, yeah, there are late filing and late payment penalties if you're an individual.
So the 15 cents just went up to
30.
$20 or $50.
Or
No.
no, this is a percentage.
Okay,
So-
no, I'm saying with the penalty and the interest.
No, it's only up to 125% of the tax due is the maximum.
Yeah, so the way that the late filing and late payment penalties are is they're a percentage of the tax. So the late filing penalty is 20% of the total tax due.
And the interest.
So exactly. Okay, so I imagine that it's below the threshold.
Well, we gotta pay for that, pensioners.
Waitress?
Okay, so I'm going to quickly go over the scenario that you brought up. It was, so if you're a non-resident and you work in Oregon, so sometimes what happens when you're a non-resident is your employer would withhold on 100% of your wages, even though you didn't work in Oregon 100% of the time. So let's say you worked half the time, then only half your wages would be subject to tax, but they withheld 100%. So what you would do is you would file this OR STI, and let's say you made $50,000, you go, oh, I only owe $25, not $50, you can get $25 back if you file this return. If you don't file the return, then it doesn't matter.
Okay, but
No, I know how popular we
so
are.
this is for all Oregon wages, just regardless of where you live.
Mm-hmm.
Okay, 'cause I only work in Oregon, but I don't live here,
Mm-hmm.
so we still owe the tax.
Yeah.
Okay, is that
Oregon
not
income
clear
base.
with your notes?
So, if you work in Oregon, your Oregon employer would withhold this for you. You don't need to file a tax return.
Well,
Unless you want to get a refund in the case where you work half in Oregon, like I explained now. Okay. We're gonna move on and make sure I have no additional important notes on this. We'll skip the fun facts. Moving on to the W-4, so
yeah.
W-4 got changed. Basically what they did is they adjusted the withholding tables down because people on average will be owing less tax. They took into consideration the reduced tax rate, the decrease of the exemption, and the increase of the standard deduction, and they came up with new tax tables. So, yeah, basically, they kind of wanted me to go over in general why it's important to, accurately withhold on your W-4. Like, you want to calculate the actual amount. The idea is like, you'll do an estimate based off of this is how much money I make, these are my deductions, these are my credits, whatever, this is going to be my tax liability. You want to be roughly at zero at the end of the year. So what they did is they changed the amount of the allowances. So I think, don't quote me on this, I think it was limited to 4 allowances, and they've extended it to 12 allowances possible. And so, this is for federal. We're talking about federal. And then we will move on to the Oregon in just a second. So I just want to lead in with the federal before we get to the Oregon. Go ahead.
They went back and reverted back to the other form because it became inconsistent. If I was correct. Yeah, so they're still using the old 2018 W-4 where you can put allowances in.
Yeah. So, we'll move on to the Oregon form. So Oregon now has a specific Oregon W-4 form. Before, you would just get a federal form and you write Oregon on it, and that would be your Oregon W-4 if you wanted to have different withholding. But now we have our own form. There's a few things I want to go over. So if you got a new job, for example, in 2018, or you filed a federal W-4 because you said, I'm going to owe less tax, so I want to withhold less, but you didn't file a separate thing for Oregon, then there's a potential that you could be under withheld because the federal tax rates have gone down while Oregon tax rates have remained the same. So your average tax liability will roughly be the same. Obviously, it depends who you are, facts and circumstances, but on average, they'll be roughly the same. So if you had more allowances on your federal, that flows through to your Oregon, now you're under withheld. And the reason that's a problem is because of the underpayment penalty, which is technically not a penalty, but it's interest. But, yeah, it's a big thing. So let's see. So we came out with this form, and basically there are 3 pages, just like the federal. And the idea is you'll go in, you'll calculate this is how much my tax liability is going to be. It's not being released until December, so they wanted me to hammer home. So you basically have December to increase your withholding to be under the.
Okay.
So just making sure you want to be under that UND amount, so you don't pay UND. So yeah, basically we didn't. This kind of tax, this whole tax thing was a kind of rushed, right? So we're like way behind on some of the stuff, so we're kind of just now getting caught up on some of it. So we weren't able to come up with a W-4, and it's not really being released until next month. So yeah, they just want people to think about basically changing their withholdings to do their best to avoid it, UND. This is the form, more or less like I described. You calculate your deductions or credits to come out with the most accurate potential tax liability. This won't really affect people who didn't change. So if you just kept your same job and you kept your same allowances, you should be fine. It shouldn't affect you. It's only if you got a new job or if you decide to file a W-4. and didn't file a separate Oregon one. They also want me to go
I have
over
a quick question
Oh, go
on
ahead.
that. Are employers going to be notifying their employees?
About
No.
what?
Hey, there's an Oregon thing, you guys wanna do something for the 1 month?
Mm-mm.
No,
Aren't they?
she's asking if the employer notices you're not withholding much, will they let you know?
How do they know?
You ask your employer, I don't know.
Don't think so.
Okay. Yeah, I don't wanna speak on behalf of the employers, I don't know.
If an employee wants to just go with single and zero, or married but finally gets a single rate and zero to have the most deducted,
They can still do that.
they can still do that. Is every time I've seen people use the personal allowances worksheet, that's when they do a problem.
Yeah.
Because I've seen it, I've seen guys go, oh, I want to do exempt for a month.
And
he
forget
never
to
chooses that
change.
because he's got like 6 months of exemption,
Yeah.
he owes Fed, he owes Oregon,
Rough.
his wife is ready to, take a baseball bat to him.
Yeah, some employers require their people to give them 2 separate W-4, one put Oregon only and the other one's the federal,
Yeah,
before they'll change it if it's different.
yeah, no, I'm just saying that on the
Yeah.
Oregon or the federal, it's
I see what you're saying.
I just put an X through that and say, don't pay any attention to this part.
Yeah, that's what
I
I
know.
always do too. I said, don't, they should just do away with that. Because it hurts.
Especially if they can't claim their children, and they say, well, I have 3 kids, but are you claiming them? Well, no. Well, then don't put them on your withholding.
There was an article in the Tax Institute, I think, stating that the IRS technically would like to eliminate refunds. So we're trying to get as tight as we can for our withholding.
Okay,
It's always been that way, though. They want you to break even or out.
The new formula.
so they want me to talk about the withholding calculator, and I just want to reiterate the idea of this. I understand, like, sometimes doing a more complicated version can, like, come back around and maybe confuse you later, but the idea is there's potential to be under withheld this year. You want to figure it out this year so you don't have the UND this year. And another thing that a lot of times people will rely on, since the employee business expenses went away, that could be another reason that you could be under withheld, that specific reason, because that's like a pretty common deduction that people have. And so if you really rely on you need to bring down your tax liability and you won't have that this year, that's another thing where you might want to look at it and go, oh, I should be withholding more. But again, you only have 1 month, so do your best.
Make an estimated payment.
See, well, okay, so I asked about this. You can't make estimated payments to fix this scenario. So if you make an estimated payment, then you should have been making estimated payments throughout the year. So if you make one at the end of the year, you will just be charged UND on the amounts that you were under withheld the rest of the year.
Yeah.
Which could be less, right, because you still did it for 4 quarters, you just didn't do it for the first 3 quarters. So depending, maybe if you're like really not going to increase your withholding, maybe that is the way to go. I don't know. Let's see. Yeah, basically, I'll just briefly go over this. So if you go into the Oregon Department of Revenue website, they have like 4 columns, and if you go to the far right, they have Revenue Online. You click on Revenue Online, you see the screen. It's highlighted bit here. It says Calculate Withholding. And so you go there, and basically this calculator, it just asks you questions, you fill it out. I have this much income, I have these credits, these deductions, and it comes with a tax liability. It also has a bit for taxpayers who don't understand, for example, what a filing status is. A little information about it. Yeah, if people don't understand, they have like a little box you can read, and like, oh, that's what it is, this is what I should choose, just for information purposes.
I'm the head of household, I'm the only
head of
person
my
there.
household,
Yeah, so why can't I get head of household?
There you go.
My name's
Okay, is there any questions on the withholdings or W-4s or anything? Okay. So some of the form changes, we'll quickly go over these. Let me know when we need to go to a break. They told me people were really, angry about breaks, so.
Hold on.
Whatever you guys want to do, I'm ready to do. But they told me, like, don't go over or people will, like, mutiny on you, so.
They should have known today. You were trying to get up and walk out.
Fine with me. So, there are 2 new check boxes. One for Federal Form 8886, if you have a reportable transaction disclosure statement. Yeah, and then for federal disaster relief, I've actually seen a decent amount of federal disaster relief. People basically, they were in Hurricane Harvey or the wildfires or something like that, and it's declared a federal disaster area. And so you basically, you get this relief from payment and filing, you get this extension of time. And so we got a lot of people who are being charged penalties, and then they would submit a thing that says, hey, basically I was in a disaster area, and so we would waive the penalties. Now we have a box where you can just check it, and you say, well, I was part of the disaster relief area, and so that's good.
How do you qualify if you're an Oregon resident?
Only if you're inside of the disaster relief area.
Living
Huh?
or working
Living.
or owning property?
No, this is if you have to file an Oregon tax return, and you were in, for whatever reason, you were affected in a federal disaster relief area, regardless of your, like if you're a corporation, person, whatever, it doesn't matter. If you had to file in Oregon and you were part of a disaster relief area, then you can check the box. So Form 40N and 40P, they had some lines that reference the 1040, and as we all know, the 1040 is not like a postcard, basically. It's not like a full-on form anymore, so it doesn't have lines. So it would have said, whatever, we'll reference line 10 on the 1040 that doesn't exist anymore, so they just removed those. Instead of changing it to whatever, statement 4, line this, whatever, they just got rid of it. And so that's a good time to bring up, basically, so prior you were required to attach your 1040 with your individual income tax return. Now you have to attach the postcard and the statements, so you have to attach statements 1 through 5. I think there are 6 statements, and the 6th one is like a foreign transaction statement or something like that. I can't remember exactly, but you don't have to attach that one. You just have to do 1 through 5. So the Oregon Schedule A is on the next page. No reason to talk about it until we go to the next page.
So there's no way Oregon won't download those to the IRS. All those forms.
Well, if you e-file,
Electronically, right?
if you e-file, those go with it, right? You'll be good to go. But if you need to like physically attach it, then you have to make sure you attach 1 through 5. Yeah, if you e-file, you should be good. I think it's something like 90% of people e-file or something like that. So. Okay, the Oregon Schedule A, it used to just be a worksheet, now it's an actual form. And so, if you'll see here, it says must attach your Oregon return if itemized. So if you have a federal Schedule A and you itemize, and you also itemize for Oregon, you have to fill out an Oregon Schedule A. So in all scenarios where you itemize for Oregon, you have to attach an Oregon Schedule A. This is what you'll be filling out to do your Oregon Schedule A. So, this falls pretty closely to the federal form. It obviously does not have a place for Oregon income taxes. It has a place for state and local income taxes, but it says on there, it's kind of hard to see, but it says do not include your Oregon income taxes. The state transit tax, don't put it there. It also says sales taxes. We don't have sales taxes on the Oregon Schedule A. So we follow for medical. Yeah, so basically we follow, I may have already said this, but we are attached to the $10,000 state local income tax limitation. So if you had, for some reason, state local income taxes from other states, and you weren't claiming a credit for taxes paid, because you would have to have those back if you were. So let's say you weren't, and you can only have a limit of 10,000 on those. Go ahead.
Okay. How do we figure out, are there ordering rules? So let's say you got 5,000 in property taxes and you got 10,000 in state withholding. How do we make sure that it doesn't take the 10,000 and then make you add it back next year?
So there is no specific add back for Oregon, right? There is for federal, right? Because there's a line like you have to include your state income tax refund.
Right.
And I was going to cover this.
Good, okay.
I'm on top of it. Yeah.
All right.
So they have.
That's fine.
Yeah. So basically, the IRS has not given guidance on this. So We don't know. My guess is that it would be proportional, because I don't see another way that really makes a lot of sense, but I don't make the rules. So we'll have to wait and see, and so that would be when you file your 2019 return in 2020, right? So they have some time to kind of figure it out. But presumably, yeah, you would do it proportionally. So if you had half property taxes and half state income taxes, you would only have to include half of your state with your refund, yeah. Okay, so
Great, another form, Kathy.
the mortgage interest got changed to only allowed to be deducted on indebtedness of $750,000 or less, as opposed to what it used to be as $1 million, and this is only in debt incurred after December 15th, 2017. So if you were, before that, you had $1 million loan, you should be good, you can still deduct it, but if you got your loan over $750,000 after December 15th, then you don't get to do it.
Oh, darn.
Why do we have a new Schedule A?
Because they're not getting the federal
Okay.
Schedule A.
Yeah, so many people are not gonna be, using the federal form, right? So, there's gonna be such a huge reduction in the, number of people who are itemizing for federal, and they said, well, this would be a good time to make this worksheet an actual form. So I actually have stats on this, hold on. Yeah, fun fact, I think they said 500,000 people are expected to itemize for Oregon only. And that is, so the federal decrease, so it was 40% of people would file for federal, for Schedule A. They would file, itemize their deductions. That would be only 15% of people. That's like a huge decrease in the amount of people, because they increased the standard deduction. What was your about that? Now back to all the stuff they removed. So they removed personal casualty losses. So if your house burned down, no good. Yeah, pretty much. So if you have a business casualty loss, it has to be a casualty loss on the asset that is income producing. Then you can still take it as another miscellaneous deduction. As we all know, miscellaneous itemized deductions have been removed. There is no EDE, there is no tax prep fees, there are no investment expenses, no hobby loss expenses. We'll distinguish that from other miscellaneous deductions, which is things like gambling losses, business casualty loss. It says here, Schedule K, Form 1065B, Box 2. I don't know what that is, but you can take that as another miscellaneous deduction. Federal estate tax on income in respect of a dissident and claim of right of over $3,000 and unrecovered investment in a pension. Those are deductible as other miscellaneous deductions.
So Oregon is gonna have miscellaneous deductions even though federal is not.
They will have other miscellaneous deductions, they will not have miscellaneous itemized deductions, which is subject to the 2% limit.
Right.
For the mortgage interest, is home equity included also?
Depends what you use it for when you get it.
Yeah, but like going forward on the Fed, regardless of what you use it.
No.
For Fed, what it is it's a combined amount of $750,000 of indebtedness. So you can use your home equity, you can take out a home equity loan as long as you use it to basically purchase a house, repair your house, qualifies things. You can't use it to pay off personal credit cards or buy a car or whatever. And I'm pretty sure you used to be able to do that up to $100,000. Now there's no $100,000 limitation, it's just one combined $750,000 limitation, and it has to be for qualified use.
We have a lot of questions to ask this year, so I believe that that's gonna be a really nice audit trigger for the IRS going forward. And for the state of Oregon, you guys are gonna start looking at and saying, all right, we wanna know when these loans were taken out, we wanna show that, have you proved that it was used to purchase or improve? That's gonna be a record.
One thing, so there'll be a decent amount of people who don't have to file for federal, but do still have to file for Oregon, because the standard deduction increased so much that people will just be below the filing threshold. So that's just something that might come up. Okay, so we stopped printing the publication OR 17 as of this year. Yeah.
But it's still online.
It's still online. You can access it online. You just cannot get a physical copy from us.
Look at that loss of revenue, the $5.
Basically, they cited like going green and saving costs and basically a lack of interest in getting the publication. So it was less than 2,000 people last year. They also said like the people you're speaking to will be part of that 2,000. So. Yeah. I mean, I probably have going back to like 2010, but some people have them going back way back. They have like all of these printed forms. So yeah. Unfortunately, there's no more printed OR 17.
Print the office.
Yes.
The 2018 should not be available yet.
No, but it'll be available.
It will be available. It's not available as of this moment. I want to say it's coming out in the next couple of months. I don't know. They gave me a copy and they said don't share with anybody. They don't know exactly when it's coming out. I want to say in December. I'm not part of the group, sorry, so I don't know specifically when it's coming out. I want to say it's in December. I just don't want to like tell people a date and they're like, what's going on? So
So the $5 that we paid for our copies, can you give them any money, huh? Can you give them enough money?
Well,
they just
2,000 times
this is like not enough
$5,
people are interested.
$100,000. Suggested $5.
Yeah, and in combination with trying to go green, basically, they just decided to pull the plug on it, so. Yeah, send your complaints in, do it, make sure, let them know.
You sure you don't say Michael Phelps?
You can send it to me, I'm gonna forward it to somebody else, but you can definitely send it to me.
Well, I was gonna say, you all ask for your gold medals, right?
Oh yeah, there we go. Michael Phelps.
Yeah.
Okay, so we have Oregon administrative rules, some changes. Anybody want to take a break? You guys sure?
Take 5.
Okay, we'll take a break. We'll get 10 minutes.
ouch.
State transit tax, we already talked about this. Employer is required to report on box 12, or excuse me, box 14, W2. So that will be an indicator. Okay, the new heavy equipment rental tax. This probably won't be that big of a deal, but I'll go over it. So, shortened to HERT, it's basically what it is. So if you have more than 50% of your rental income is renting heavy equipment, and all of your rental income is subject to the 2% heavy equipment rental tax. So, you know, if you rent things like backhoes or bobcats or large machinery, things like that, right, construction projects, you be subject to the tax. And the reason this tax came about actually is because all these companies, they were basically like, we pay property taxes to all these counties. We've got all these things on our books from however many years ago. We don't even know if we own this stuff anymore. We're paying property taxes. It's like an administrative nightmare. So basically they said, why don't you just charge us the tax up front and we don't have to pay the property taxes anymore. So this is in lieu of property taxes. So we distribute this money that we get from this out to the counties. That's a 5% nominal fee for Department of Revenue.
For businesses?
This is if you rent heavy equipment.
So if your business is renting.
Yeah, if your business is renting heavy equipment. If you go to like rent one, you may see the tax on the invoice. You know, technically you are not liable for the tax, but they may show it and charge it to you anyway, you know what I mean? You don't have to remit the tax to the, yeah. So, okay, the last known address, this is not really a change in rules, this is more of a clarification. We always use the last known address on taxpayers. I think the issue came up where somebody was questioning our basically authority to use the last known address or something like that. Okay, maybe it's not clear enough, so we changed it to be a little bit more explicit. So yeah, we use those last known address. The, moving,
This one might follow the federal rules of last known address, and then that'll stop all of it right there.
sounds good. You send that in. Let's make it sound good. Yeah, do
Follow
it.
the federal on that one.
So moving expenses for part year non-resident, obviously moving expenses are gone except for military, active military and certain military expenses. This is basically to establish that prior years, you can still, you know, for not 2017 and prior, you can still have moving expenses. And also when it comes back in, and I think it's 2025 or 26 or whatever it is, these would be the tools that you would look to be like, how do I calculate my moving expenses? So yeah, not necessarily anything you need to be super worried about. Now operating loss, we tied to federal, no carrybacks, only carry forward. And for some reason the examples have been taken out of the rules. So they decided to add the examples back in. Somebody just messed up for like 5, 6 years in a row, nobody noticed, and then somebody noticed and they were like, whoa, let's put the examples back in. So market-based sourcing. So this is going to be interesting. This is, the general idea is, this is a change in the sourcing of services compared to how it used to be. It's basically you have to source your service to where the benefit was received, and we'll go over some examples of that. This only affects basically intangibles, but specifically services is what this will mostly affect. So let's see. Okay, I should mention that if you provide a service to a customer and it's not clear where their residence is, so it's not clear where the benefit would be received for the service, you need to ask them where they live. If it's not clear, you just go by the billing address that they gave you. If a particular customer is more than 5% of your total sales, then you need to make a concerted effort to figure out where they live and determine their residency, I should say. So let's go over a few sort of different examples. We'll go over the professionals example, so tax preparers, lawyers, architects, things like that. So let's say you're in Vancouver, because this is like the most sort of common one. You're a preparer in Vancouver who has Oregon clients. So if you prepare a tax return for an Oregon resident, the sales of those fees that they're paying to you are now taxable to Oregon. Prior to this law, they were not taxable to Oregon. It was calculated based off of, what was that called? Can't remember. It's going to come back to me. But, so basically, yeah, if you're Vancouver tax preparer, you now may have to file an Oregon tax return if you have Oregon clients.
Huh?
That they have a difference in the state tax where, or you just have the right to request from employers out of state, but yet you can collect from people in other out of state.
So the idea is basically, do you have a connection to Oregon? What's your connection to Oregon? So your connection to Oregon in this scenario is you're providing a service that is, the benefit is ultimately received in Oregon. I mean, they're not directly connected, but I'm just saying the general idea is, you know, there's no really connection to Oregon. If you're just operating your business in Washington and you happen to have somebody who lives in Oregon, the onus is on the employee, not on the employer. Where in this case, you're selling things that ultimately have an effect in Oregon.
Now, would this be if you were a tax preparer who was a sole proprietor or a tax preparer that worked for a company?
Okay, so
We're looking for H&R Block over in Vancouver, and we've moved over there because, you know, of reasons, and a lot of our clients decided they still want to see me, so they came to Washington to see me.
We'll have to delegate that revenue for the Oregon residents, and they have to pay the tax.
So if you were an employee of H&R Block, you know, and you're not running your own sort of business, then it's like treated as a W-2 wage, and this is not for employees, this is only for businesses. Well, it could be sole proprietors or partnerships or whatever, any type of business. But this is not for W-2 wage employees.
Is that not basically based on the address of the individual?
Right.
Yeah, more or less, yeah.
Yeah, so they're trying to decide that.
Technically it's residency, but yeah, it's pretty much just.
So how is that, calculated on the tax? How does that, get reported?
Yeah, so that's generally called apportionment. So there's a Schedule AP 1, I want to say it's at the bottom of AP 1 in the sales section. You'd have something like,
Prorating.
yeah, basically I had this much Oregon sales, I had $5,000 of sales from Oregon customers, I had $50,000 of total sales, that's 10%. My net income, 10% of my net income is basically apportioned to Oregon.
They've always had that workshop for like the TriMet
Yeah, it
form.
works the same way as you're trying to report your
Yeah.
private income.
You have to prorate it.
And
So-
how is it gonna be like, checks and balances, how is anyone gonna check it?
You mean if somebody
How
flags
does Oregon
it?
know that somebody from Washington did a tax return for an Oregon resident?
I mean, how does Oregon, I mean, you know, what is it? Sometimes there's things that we have like information about, sometimes there's things we don't have information about. If we have a record that you know, whatever, let's say I do an audit and your CPA is whatever, he's in Seattle and you're an Oregon resident, I was like, hey, did you pay your taxes on that? And he'd be like, I don't know. You know, go ahead.
Does the reverse also apply? So if we in Oregon are doing tax returns for people who live in Vancouver, does that?
So, if you're an Oregon resident, all of your Oregon income is always taxable to Oregon. You may be, and we'll get into this in a second, you may be eligible for credit for taxes paid to another state, sort of a separate issue, but if you're an Oregon resident, all of your income from everywhere is taxable, regardless of where it's from.
Washington doesn't have.
Yeah, Washington doesn't have an income tax, but let's say, for example, you lived in Medford and it's California.
Yeah.
California does have an income tax. Then you would take the credit for taxes paid on your California return because you can't take California credit for taxes paid on your Oregon return.
So you have
Therefore,
to
you're
make
Oregon resident.
sure you look at Oregon's rules to see which states they allow you to do a tax receipt to other states.
Yeah. Yeah, it can get pretty complicated. Go ahead.
So I understand that not the supplies, just kind of a question in general.
Sure.
You got a large accounting firm that does taxes all over the country.
Yeah.
So they basically do a bunch of Oregon tax returns. That company is now going to have to pay Oregon taxes on those clients?
Yeah, a lot of those companies already do, but yeah.
They already do?
A lot of them have offices here anyway.
Okay, but I'm talking about somebody who just might be, you know, a superstar and he happens to move out of here and his clients want him to do or her to do the tax returns. Now they're basically in Idaho or wherever. That person then basically now good old Oregon is saying we're going to get as much of your money as we can. They've added this as additional revenue source, correct? For those self-employed people that do taxes of clients that reside in Oregon.
Well, I can't speak to the law and like, you know, targeting tax professionals or something like that, but yes, the law is that if you have services provided to Oregon, you know, then yeah, the benefit received here, then yes, you have to still continue to file a tax return even if you move out.
Just like I do virtual returns, and then I have returns coming in from all over the U.S. Well, I'm paying income tax on all of the revenue from each of those returns that I do from Oregon for other states.
And collecting sales tax on those things.
And collecting the sales tax from all those states as well, because those returns come in to me with different pricing and sales tax.
Okay, I was going to get to that. I'm going to go with a different set of examples here in a second. So let's say I was actually going to use nail salon, but so I was going to give an example of basically somebody who mows lawns and somebody who does a nail salon. So let's say you mow lawns and you physically come into Oregon to mow somebody's lawn. That is taxable to Oregon because it's physically in Oregon. It's a service that you provide in Oregon. You have to report those sales. If you are living in Washington, you mow somebody's lawn in Washington, there's no connection to Oregon. It doesn't matter. If you have a nail salon and somebody from Oregon comes up to Washington to get their nails done, that's not taxable to Oregon. So those types of services have to be physically performed in Oregon. The thing about professional services is the benefit is ultimately received in a different place than, well, potentially in a different place than where you performed it. It used to be cost of performance, that's what it's called. It used to be cost of performance where most of your, it was determined where are most of your costs. So if you had an office in Vancouver, all of your costs would have been in Vancouver, so you would never source anything to Oregon. So they've changed to market-based sourcing. This is effective as of January 1st, and affects all types of businesses. I was going to briefly go into, we kind of already talked about this, but the credit for taxes paid. The Washington business and occupation tax does not qualify for credit for taxes paid to Oregon. There is no de minimis threshold. I sort of use your good judgment, I suppose. No, 2018. Is there any more questions on this? If a plumber came into Oregon and performed, did plumbing, yes, you'd have to pay. You have to source those sales to Oregon. Electrician, same thing.
Now, what do you tell these clients? I have a individual who does HVAC. The office is in Washington, but he spends time in Oregon doing projects. How do they track? How can what advice do you give them with their employer to say which one's going which way? This amount was Oregon, this amount was Washington.
Okay, hold on. So this person is an employee?
He's an employee, right? And
okay, well he doesn't have to deal with it because he's an employee.
okay, but he's a he's a contract person. It's a 1099.
Then just the billing address or the physical location where he performed the service.
Okay.
Just have like job numbers, for example. There's a lot of people who have job numbers. Job 1 was at this address for this amount of money. That's Oregon. Job 2 somewhere else, not
right.
Oregon, and that's how you would do it.
Okay.
Say again, landlords? So rental income is wherever the property is physically located, and that doesn't count as a service under this law. Rental is not a service; it's a separate issue. That's allocated to whatever state it's physically located in. Okay, moving on. 2019 tax law changes. So this is not 2018, this is 2019. These are things that have been passed and will take effect in 2019. So just something to look forward to, whatever, or be angry at, or whatever. So the first-time home buyer subtraction, very similar to the Oregon College Savings Plan idea. It's very similar. You have to have a particular type of bank. Basically, your bank has to offer this special account where you can basically subtract up to $5,000 per year or $10,000 if you're married filing a joint, to a total of $50,000. And so the idea is, if it's your first time buying a house, you can use this money there's a list, basically for your down payment, for your closing costs, realtor's fees, appraisal costs, loan origination fees, and I assume there are more items than that. I assume that's not exhaustive list. Go ahead.
So, are you using first time buying a house ever, or the federal definition of a first time home buyer?
No, it's a separate definition, and I'll get to that in a second.
It doesn't start till 1/1/19.
Yeah, it doesn't start until 1/1/19. You have to have the bank account. You start putting the money in, and so it's every 3 years is what the law, the rule says. So if you purchased a house, I know it says first time home buyer, but it's not true.
So federal is every 2 years.
It's a completely separate rule. Yeah. Yeah, the
We
other
do
two.
every 2 years in federal, I think.
Okay.
So it's 3 in Oregon.
So it's 3 in Oregon. So basically, it says first time, it's not true at all. 3 years, every 3 years, you can take money out of this account to buy your primary residence. And, yeah, as long as you haven't purchased one in the last 3 years.
Purchase or own.
So I can sell my house that I've been in it for 20 years and buy a new one and qualify for this?
As long as you waited 3 years
You have to wait 3 years.
from when it was sold. So it has to be your primary residence. So you can't have a primary residence and then go buy a new home. And there's going to be as it says on here, it's hard to read, there's going to be a frequently asked questions posted, because there's any number of nuances and scenarios. What if I buy a house in Idaho? What if I set this account up for my son? I don't know. There's going to be frequently asked questions. I asked them some of these questions in the meeting we had. Go ahead.
Will this be like a designated account, like will the credit union or the bank or whatever, it will be earmarked as a fund for
Yep.
home purchase or whatever?
Same exact thing as the college 529 savings plan, yeah. Yeah, so I don't have all of the nuances and answers for all of the different scenarios, and so they said they'll post a fact to address a lot of those. We were going to our meeting, we were trying to come up with different scenarios, and they were like, no, we'll handle it.
So I sell my house now, the funds I get from my house, I fund this account, I wait for 3 years and then I go.
Sounds good.
Hey Diane, when you're done, look me up on real estate broker.
You have to wait, and you can only, obviously, so if you put like $50,000 in this account in year 1, you can only deduct $10,000.
Yeah.
So I guess you just do the $10,000 from one account to the other account, whatever, you know. Okay, residency determination. This probably will only come up in audit, I would imagine. I don't know too many other scenarios where this would come up. But it says don't consider charitable giving when determining somebody's residency.
That means if they are, I had one client who was an Oregon resident, but they went back to New Mexico to close their father's estate, and they donated to the Goodwill in New Mexico $5,000. So I think it's similar to that. Just because you gave all this charitable to another state doesn't mean that's proving residency.
Yeah, one way or the other. So as I understand what happened, if somebody got audited, the auditor said, you gave all this money to this Portland charity. You're clearly still connected to Oregon.
Yeah.
I'm not sure what happened as far as the result of the case, but this person was not happy, and so they went to the legislature, and they said, this doesn't make any sense, and the legislature, yeah, so they just basically said, you don't take that into consideration when determining somebody's residency. So they don't want to discourage people from giving to Oregon charities.
But don't use it.
Yep. So, conflicting claims, like this is also something that would likely only come up in audit. Basically, if you have there's a few different scenarios. If people are claiming the same dependent on 2 different tax returns, it's a conflicting claim. Or if one person has a deduction for $10,000 alimony paid, and obviously they got rid of alimony, but it's that an example. And then the other person is claiming only $5,000 of income. You're like, okay, what's going on? And so that's a conflicting claim. And so essentially, they were really strict on what you can share with other people when you are the Department of Revenue. They kind of loosened it in these conflicting claim scenarios. So,
alimony, my understanding is that if you, like, I was divorced in 2004. I'm getting part of my ex-husband's retirement pay. He